You can buy a house with a reverse mortgage. Why would you? Most people don't realize there's actually a mortgage designed specifically for buying a retirement home. And when people first hear reverse mortgage, the reaction is usually, why would I do that? Fair question, because for many seniors, the retirement should not be about squeezing every last dollar out of their portfolio and just getting by. It's about improving lifestyle, flexibility, and confidence while preserving liquidity. Let me give you an example. A 70-year-old purchasing a $700,000 home today might assume they only have two choices: pay all cash or take on a traditional monthly mortgage payment. But there's a third option: a HECM for purchase, a reverse mortgage designed for seniors, home equity conversion mortgage. And that could allow the same buyer to purchase that same home with approximately $471,000 cash instead of the full $700,000. That means roughly $229,000 stays in their pocket, and that's the reverse mortgage contribution. Now let's make this fun. Picture the retirement community they thought was out of reach. A resort-style pool, fitness center, organized activities, beautiful clubhouse, the whole 9 yards. The lifestyle they actually pictured for retirement. But the HOA is $600 per month, so they conclude it wasn't realistic. But purchase with the H for P, $229,000 less cash divided by $600 per month. That's over 31 years of HOA payments funded by the cash they didn't have to spend on the house. Same home, same community, same lifestyle, different strategy. Now here's the part most people struggle with. Yes, but there's a loan balance growing over time. True. Can't get away from that. Interest and mortgage insurance accumulate, and because there's no required monthly payment, the loan balance does compound. We got that. That's real. But here's the surprising part. In many scenarios, homeowners still preserve substantial equity over long periods of time because the loan is only one part of the equation. In this example, the home value starts at $700,000. The reverse mortgage loan balance starts much smaller, roughly $255,000. So yes, the loan balance grows over time because interest and mortgage insurance accumulates. And without a required monthly payment, that growth compounds. But the home value may also grow over time. Using a reasonable long-term planning assumption of 4% annual appreciation, the larger asset, the home itself, can grow fast enough to offset much of the loan growth occurring on the smaller balance. That's the part most people don't expect. In one example we modeled, equity at purchase, approximately $444,000. 10 years later, equity had actually increased. 16 years later, equity remained close to where it started. Most people expect equity to disappear. That's often not what the math shows. And here's one more surprise almost nobody realizes. A borrower can still make payments whenever they choose. In fact, some homeowners use the flexibility strategically. Make payments when cash flow is strong, stop when retirement priorities change. That preserves liquidity along the way. And when payments are made on a HECM for purchase, something else interesting happens. Those payments become an available line of credit, and the unused portion will actually grow over time. That creates future flexibility many people never knew existed, access to equity. That's why many people begin to view this less as a reverse mortgage and more as a retirement mortgage designed to create options. This changes the conversation for seniors and for the professionals who serve them. If you'd like to see a full breakdown and more information, I've linked additional resources below. This is Selland from Signet Reverse Mortgage. It'll be good to hear from you. Take care.